Ever glanced at the news and wondered why the world's wealthiest don't seem to flinch when inflation spikes? Here's a hint. They've got secret weapons. In today's dive, we're going to unlock the 7 ways rich people make money with inflation. And believe me, some of these might just surprise you. From the shiny allure of precious metals to the intricate dance of foreign currencies, we're journeying into a realm where savvy investment meets sheer genius. So why should you stick around? Well, by the end of this, you'll have insights that could reshape how you view your financial future. Let's navigate these golden nuggets together. Number 1. Real estate investment. Real estate stands out as a tried and true method of leveraging inflation for profit. When inflation increases, so typically does the price of real estate. Rich people recognize this trend, and many make real estate a cornerstone of their investment portfolios. As the general price level rises, it often lifts the value of land, homes, and commercial properties. This happens because as inflation takes hold, people begin to anticipate even further price rises, leading to greater demand in tangible assets like real estate. This increasing cost of raw materials such as wood and cement also adds to the rising value of already built properties. Moreover, those who have taken out fixed-rate mortgages will find that over time, the real dollar amount of their mortgage decreases with inflation. This means that while the nominal amount remains the same, the real purchasing power of those dollars decreases. So as inflation rises, the burden of the mortgage can effectively become smaller. This gives the wealthy an edge as they pay back their loans with cheaper money. Additionally, as rents go up with the cost of living, property owners stand to make higher rental income from their real estate investments. It's a passive income stream that benefits from inflationary pressures. Wealthy individuals often buy prime real estate properties, not just for their capital appreciation, but for their increasing rental yields during inflationary times. Number 2. Investing in stocks. Stocks, especially those of companies that have pricing power, can be an excellent hedge against inflation. Companies with pricing power have the ability to raise their product or service prices in line with or above the rate of inflation. This means that their revenues and potential profits can grow at a rate that outpaces inflation. Rich individuals, having a keen understanding of this, strategically invest in such companies, ensuring that their investment grows despite the eroding effects of inflation. Furthermore, when inflation is a result of increased consumer demand, companies might see a rise in revenues and profits, leading to stock price appreciation. The stock market in general tends to fare well during the initial phases of inflation, especially if it's driven by strong economic growth. The wealthy often leverage this by diversifying their stock portfolios, ensuring a mix of companies and sectors that are likely to benefit from the prevailing economic conditions. Lastly, dividends are another facet of stock investing that can be advantageous during inflationary times. Companies that regularly pay dividends might increase these payouts in line with their increasing revenues. For the wealthy, this can translate to a steady inflation-adjusted income stream from their stock investments. Number 3. Precious metals and commodities. Historically, precious metals like gold and silver have been viewed as safe havens during inflationary periods. Their value often rises as inflation escalates. This is because, unlike fiat currencies, which can be printed in unlimited quantities by central banks, there's a finite amount of gold and silver. As the purchasing power of paper money decreases due to inflation, many investors, especially the affluent, turn to gold and silver as a store of value. It's not just gold and silver that catch the eye of savvy investors. Other commodities like oil, agricultural products, and base metals can also see price surges during inflationary times. Rich investors often diversify their portfolios to include a range of commodities, either directly or through commodity-focused funds or futures contracts. They recognize the dual benefit of these commodities as a hedge against inflation and as assets that can appreciate considerably during certain economic scenarios. The global interconnectedness of today's economy also means that commodities can be influenced by factors beyond just inflation, such as supply chain disruptions or geopolitical events. Wealthy individuals often have access to top-tier financial advice and market insights, enabling them to make timely and informed decisions regarding commodity investments. Number 4. Investing in Treasury inflation-protected securities, or TIPS. TIPS are government securities specifically designed to protect against inflation. Their principal amount rises with inflation and falls with deflation. The interest rate on tips is fixed, but because the principal adjusts with inflation, the interest payouts, which are a percentage of the principal, also adjust. Therefore, in an inflationary environment, both the principal and interest payments increase. The wealthy are often on the lookout for stable, lower-risk investments that can preserve their capital, especially during uncertain economic times. Tips fits this bill perfectly. By including tips in their portfolios, affluent investors can ensure they receive a real rate of return that outpaces inflation, effectively safeguarding their wealth. Another advantage of tips is that they're backed by the US government, making them one of the safest investments around. For rich individuals, especially those who have already amassed substantial wealth, preserving capital can be just as important as achieving high returns. Tips, with their inflation-adjusting mechanism and government backing, provide a solution that addresses both these needs. Number 5. Owning businesses. Owning a business, especially one that can adjust its prices with inflation, can be another effective strategy. When prices rise, businesses that aren't hampered by long-term fixed contracts or regulations can simply adjust their prices upwards. This ensures that their profit margins remain intact or even grow. For the wealthy, business ownership isn't just about profits, it's about control. By owning a business, they have the ability to make strategic decisions, such as adjusting pricing or diversifying product lines to adapt to inflationary pressures. This level of control can be a significant advantage during unpredictable economic times. Furthermore, businesses can be a source of continuous cash flow. Even during inflationary periods, a well-managed business can generate revenues that, if managed wisely, can outpace inflation. For wealthy individuals, this provides both a shield against the erosive effects of inflation and a source of funds for further investments. Number 6. Foreign currency investments. As inflation takes hold in one country, its currency might depreciate against others. Savvy, wealthy investors often diversify their portfolios by holding assets in multiple currencies. This way, even if their home currency depreciates due to inflation, their foreign currency holdings can act as a hedge. Moreover, high inflation in one country can lead to higher interest rates as central banks try to curb the inflationary pressures. This can make investments in that country's currency more attractive due to the higher yield. Wealthy individuals, with their broader access to global markets, can quickly move their funds to take advantage of these opportunities. Lastly, foreign currency investments aren't just limited to holding cash or bank deposits. Bonds, stocks, and real estate in foreign countries also serve as an exposure to foreign currencies. By diversifying their assets geographically, the wealthy can mitigate risks associated with inflation in any one particular region or country. Number 7. Collectibles and art. Last but not least, many wealthy individuals invest in art, antiques, and collectibles. These tangible assets often appreciate over time and can especially be valuable during inflationary periods. As the value of money diminishes, the intrinsic value of rare and desired items can rise. Moreover, the art and collectibles market can often operate independently of traditional economic factors. For instance, a rare painting or vintage car might appreciate due to its historical significance, rarity, or a surge in popularity, irrespective of broader economic conditions. For the rich, such investments also come with an added benefit: enjoyment. While they can certainly appreciate in value, art and collectibles also offer aesthetic or emotional pleasure. In essence, they're assets that can be both enjoyed and leveraged for financial gain during inflationary times. The rich employ a mix of strategies to not only protect their wealth from inflation, but also to grow it. And there you have it, the 7 sensational strategies the wealthy use to dance with inflation. Now, whether you're looking to guard your treasures or sail into new investment adventures, you're equipped with some heavy-duty knowledge. By understanding these methods, anyone can better position their investments to thrive in an inflationary environment. Until next time, keep those financial antennas up and never stop learning. Cheers to a brighter, wealthier future.